Hi everyone, and welcome to Smith & Williamson's webinar on IFRS 16, a new reporting standard that is fundamentally changing the way we account for leases. My name is Amy Jack, and I'm joined by three colleagues this morning who will explain how businesses will be affected by IFRS 16 and some of the steps you might want to take now. First, you will hear from Stephen Drew and Ben Hamar from our Assurance and Business Services team, who will explain what the changes mean from an accounting perspective. After that, we have Alistair Shaw from our Business Taxes team to explain the new legislation that seeks to address the many tax issues that will arise for lessees. And we'll also briefly comment on what we have seen so far following the introduction of IFRS 9 and 15. You will see a couple of polls appear throughout the webinar, so please do take part in those. Please also submit any questions you have as we go along. We will have a few minutes at the end to go through as many as we can. And you can do this using the Q&A box that you should see at the bottom of your screen. You possibly already know that IFRS 16 essentially requires nearly all operating leases to be brought onto the balance sheet, along with an associated lease liability. This new accounting treatment has a big impact on tax as well, with a raft of new associated tax rules being released. Finance teams will need to understand the changes involved, and although some areas will be simplified, there is additional complexity, particularly in transitional years. These rules could also make a difference to the tax charge and particularly impact deferred tax. So really, the first challenge is understanding the ways in which the financial statements and tax position will be altered. And I'll hand you over to Stephen first, who will take you through the new standard in a bit more detail.
Thanks, Amy, and good morning, everyone. Most businesses lease or rent assets, and the requirements of IFRS 16 are designed to eliminate virtually all off-balance sheet accounting for lessees and will change the way in which financial KPIs such as gearing, EBITDA, and operating cash flow are measured. Whilst this may improve comparability, there is likely to be an impact on covenants, credit ratings, and possibly borrowing costs. Under current rules, lessees account for leases as either operating leases through the income statement or finance leases through the balance sheet, which can produce different results for what appear, on the face of it, to be similar lease transactions. Lessees are expected to be significantly affected by the new standard, whilst lessors will largely be in the same place. At a high level, the impact is that the allocation of costs in the income statement will change, with rent expenses replaced by depreciation and finance costs. This results in a front-loaded expense profile, decreased earnings and equity immediately after entering into a lease compared to an operating lease. Balance sheets will grow with capitalised assets and financing introduced, but not necessarily on a pound-for-pound basis. We would expect heavy users of real estate to experience a significant impact on debt and EBITDA. The leasing market may well develop to have an increased focus on services rather than physical assets. Depending on circumstances in the portfolio of leases, the implementation and collection of data will be a more onerous process. The new standard sets out a comprehensive model for the identification of lease arrangements and their financial treatment for both lessees and lessors. Today we will summarise the principal changes, the transitional arrangements and the tax consequences. The requirements of IFRS 16 are comprehensive and complex, and you should refer to the standard itself to determine the correct accounting treatment for any item or transaction. The standard helpfully includes 24 examples and applies to periods beginning on or after the 1st January 2019. We will now explore the core principles and summary of changes from previous standards. The standard establishes principles for the recognition, measurement, presentation and disclosure of leases, with the objective of ensuring that lessees and lessors provide relevant information. There is now a single lessee accounting model requiring lessees to recognise assets and liabilities for all leases, regardless of whether they were previously classified as operating or finance leases, unless the lease term is 12 months or less, or the underlying asset has a low value. The definition of a lease is much more driven by the question of which party to the contract controls the use of the underlying asset for the period of use. There may be some contracts that were accounted for as leases under IAS 17, which failed to meet the definition of a lease under IFRS 16 because of the increased focus on the control of the asset. In these cases, the contracts would be accounted for as service contracts. This lease accounting model requires recognition of a right to use the lease asset for the lease term and a lease liability reflecting the obligation to make lease payments. This fundamentally changes the accounting treatment of operating leases. Lessors continue to classify leases as operating or finance, with the new approach to lessor accounting substantially unchanged from previously. Lessees and lessors can apply the standard to a portfolio of leases that have similar characteristics, provided they reasonably expect that the result will not be materially different from applying the standard to each individual lease. The new standard applies to all leases except for the following: leases to explore for minerals, oil and gas and similar resources, biological assets, service concession arrangements, licenses of intellectual property, and rights held by lessees under certain licensing arrangements, such as motion picture films, patents, copyrights, etc. Lessees may, as an accounting policy choice, apply the standard to leases of intangible assets other than those just mentioned. You should see the first polling question come up on screen, and we'll come back to the responses in a moment. So what is a lease under the new rules? A contract is a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. The key phrase here is the right to control the use of an asset. Whereas previously the test was the right to use an asset in return for the payment for an agreed period of time. The difference is an increased emphasis on which parties the contract controls the use of the asset for the period of use. Control is conveyed when the lessee has the right to direct the asset's use and to obtain substantially all the economic benefits from that use. You should also consider whether the lessor has a substantive right of substitution throughout the period. This would apply if the lessor has the practical ability to substitute alternative assets throughout the period and would economically benefit from doing so. If the lessor does have a substantive right of substitution, then the lessee does not have a right to use an identified asset, and the contract is not a lease. Such contracts are accounted for as service contracts, typically with a cost spread on a straight line basis over the term of the contract. This would result in a similar pattern of expense as for an operating lease. An example of this would be where a concession enters into a contract to use a space at an airport for 3 years. The company uses its own easily movable kiosk to trade from. The contract specifies the amount of space to be provided and states that the space may be located at any one of the boarding areas. There are minimal costs to the airport of changing the space of the kiosk. The contract provides for an amount of space, but not a specified space, and the concession uses its own kiosk. The airport has the right to substitute, there are many areas available, and the concession does not have the right to object. The airport incurs minimal costs in substituting the space and would make the change to meet changing circumstances, thereby economically benefiting from the substitution. Therefore, the contract does not contain a lease, since there is no identified asset, and so should be accounted for as a service contract. If the space had been identified, then the conclusion would be different and a lease would exist. An operating lease and service contract currently have a similar accounting treatment. Going forwards, there will be a need to review contracts to determine whether there are embedded non-lease or service components. The right to use asset element may be accounted for differently to the service element. This would apply where the lessee can benefit from the asset either on its own or together with other resources from the lessor or another supplier. And the underlying asset is neither dependent on or highly interrelated with the other assets in the contract. In such circumstances, IFRS 15 should be used to allocate the separate components based on the relative standalone selling prices. Such situations might arise where there are both hardware and maintenance services supplied. This may not be a straightforward exercise. Do we have the results of the poll? Right, so the poll is showing that 61% of respondents have just started and 14% have a plan and are starting to implement. We'll now move on to initial measurement. So let's turn to see how lessees account for the initial measurement of the lease liability. A right of use asset should be recognised to reflect the lessee's right to use the leased asset for the lease term. A lease liability should be recognised to reflect the obligation to make future lease payments. The lease liability is initially calculated as the present value of the lease payments. The discount rate that should be used to calculate this present value is the rate implicit in the lease. If this cannot be readily determined, then the lessee's incremental borrowing rate should be used. This rate should reflect the fixed rate at which the lessee could borrow a similar amount for the asset in the same currency for a similar term and with similar collateral, and so not necessarily the same as an existing bank facility rate. A range of discounts may therefore apply and will have to be calculated. The lease payments included as a liability are those that are not yet paid at the commencement date, with any prepaid amounts excluded. However, there are a range of other payments to consider. Firstly, fixed payments and those that in substance are fixed payments, less any lease incentives receivable. In substance, fixed payments are those that in form contain variability, but in substance are fixed, i.e. there is no genuine variability. These might include payments that must be made only if the asset is proven capable of operating, alternatively for payments that must be made only if a certain event occurs, but where there is no genuine possibility of that event not occurring. It is hard to see that a lessee would enter into a lease for an asset that was not capable of operating, but in both cases it is virtually certain that the payment will have to be made. The existence of a choice for lessees can result in an in-substance fixed payment if every choice will result in a cash outflow for the lessee. Secondly, variable lease payments that depend on an index or a rate, initially measured using the index or rate at the commencement date. Thirdly, amounts expected to be paid by the lessee under residual value guarantees. A residual value guarantee captures any kind of guarantee made to the lessor that the underlying asset will have a minimum value at the end of the lease term. Next, the exercise price of a purchase option if the lessee is reasonably certain to exercise that option. And finally, payments of penalties for terminating the lease if the lessee is reasonably certain to terminate the lease early. A key factor in the initial calculation of the lease liability is determining which future payments to the lessor should and should not be included. This often depends significantly on what is being assessed as being the lease term. The lease term is essentially the non-cancelable period of a lease, along with periods covered by an option to extend the lease if the lessee is reasonably certain to exercise that option, and periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise that option. The use of judgment will be required to assess what is reasonably certain. The lessee will need to identify and consider all relevant facts. The right of use asset is initially calculated as the sum of the amount of the initial measurement of the lease liability as just discussed. To this is added lease payments made in advance of the commencement date, less any lease incentives already received, then add the initial direct costs incurred by the lessee and the estimated cost of dismantling, removing or restoring the underlying asset or restoring the site on which it is located. For example, a lessee enters into a 10-year lease of the floor of a building with an option to extend for 5 years. Lease payments are constant during the initial period and are at a higher constant rate for the optional period, all payable at the beginning of each year. Initial costs are incurred by the lessee consist of a payment to a former tenant and a commission to an agent. The lessor agrees to reimburse the lessee for the commission and for the lessee's leasehold improvement costs. At the commencement date, the lessee concludes that they are not reasonably certain to exercise the option to extend the lease, and hence the lease term is determined at 10 years. The interest rate in the lease is not readily determinable, and the lessee determines that the relevant borrowing rate is 5%, which reflects the fixed rate applicable for the asset in the same currency for a 10-year term with similar collateral. At the commencement date, the right to use asset is calculated as a first-year lease payment that was paid in cash, plus the present value of the remaining 9-year lease payments based on a discount rate of 5%, plus the initial total costs, less the contribution from the lessor for the commission. The lessor contribution to leasehold improvements is not a lease incentive under IFRS 16 and is accounted for as a deduction against the cost of leasehold improvements. The lease liability is a present value of the remaining 9-year lease payments. After initial recognition, the right of use asset will be subject to depreciation and impairment. It is possible in certain situations to account for the right of use asset at a valuation rather than cost. The lease liability will be reduced by the future lease payments to the lessor and increased as the discount is unwound through finance costs. If the right-of-use asset meets the definition of an investment property, then the asset should be accounted for at the entity's choice of model, i.e. at fair value or cost. It is possible that throughout the life of the lease, the pattern and amount of the actual lease payments will differ from the estimates made on initial recognition. The standard contains specific requirements on when and how to account for these changes, depending on whether the contractual clauses of the lease have been modified. Payments based on an index or a change in the likelihood of the lessee taking up an option to extend the lease term would lead to the lease liability being remeasured. The right-of-use asset should also be adjusted unless its carrying amount is reduced to zero, in which case any remaining adjustment is made to profit or loss. Two different methods can be applied depending on the reason for the remeasurement of the revised lease payments. Method 1 uses an unchanged discount rate where the residual guarantee amount changes. The variability of payments is resolved to become in substance fixed payments, or future lease payments change to reflect an index or rate, although this would not apply to floating interest rates. Method 2 requires a revised discount rate to be used where the future lease payments change to reflect changes in floating interest rates or where the lease term changes. Lease liabilities are either presented separately from other liabilities on the face of the balance sheet or are disclosed separately in the notes. After initial recognition, the lease liability is increased by unwinding of the discount and reduced by the lease payments made to the lessor. The unwinding of the discount is treated as an interest expense, and any cash outflows of interest are presented as cash flows from either operating or financing activities in the cash flow statement, depending on the entity's policy for the classification of interest payments. Principal payments of lease liabilities appear as cash flows from financing activities. Right-of-use assets are either presented separately from other assets on the face of the balance sheet or are disclosed separately in the notes. The assets should be presented in the categories that they would be presented in if they were owned, i.e. PPE versus intangible assets. Depreciation of a right-of-use asset is presented in the income statement in line with the requirements of IAS 1. The depreciation expense and the interest expense cannot be combined and presented together in the income statement. As lessor accounting is largely the same, lessors will not generally have to make any adjustments on transition. There are some complications for subleases and leaseback transactions, which are covered by specific transition rules, offering a choice of a simplified approach in both cases or a full retrospective application. I'll now hand over to Ben.
Thank you, Stephen, and good morning, everyone. Looking now at modifications, and I want to look at 4 relatively common modifications that we can have to leases. The first being where lease payments are changing in respect of inflation, so increased costs. This might be because of an RPI link specifically in the lease contract as it is originally written, or it might be that rent reviews are taking place to uplift the lease payments to market rents. We'll include our initial estimate of payments based on whatever rate is applicable at the start of the lease, so the RPI at that date or the rent payments as agreed in the original lease. When the terms are changed, i.e. when a rent review takes place, or when the RPI change has an effect on cash flows, at that point we will change the estimate for the lease payments going forward. Not whenever RPI changes in between those times, only when cash flows are changed. At that point we will remeasure the lease liability, calculating it again for the new lease payments over the remaining term of the lease. In doing that calculation, we will keep using the original discount rate, the rate implicit in the lease or the incremental borrowing rate at the time the lease first began. To match the double entry, the change for that will be reflected in the right-of-use asset by increasing the right-of-use asset. The second type of change we can get relates to where an option to either extend or shorten a lease, which was originally not considered to be reasonably certain, becomes reasonably certain. This is a much more judgmental question that IFRS 16 is asking, because now we're having to say, when does that judgment change? When does it become reasonably certain that we will extend a lease where we have an extension clause, or when does it become reasonably certain we will not exercise or stop not exercising a break clause? Now, this judgment might take place at a different time to when it is finally agreed, and therefore the accounting will be more carefully considered. When recalculating the lease payments in this situation, we will, however, use a revised discount rate. So the new interest rate implicit in the lease, based on the new terms, or the incremental borrowing rate as at the remeasurement date. This, again, will affect the right-of-use asset where we are extending a lease and when we are shortening a lease. However, if we actually take the right-of-use asset to zero, any further adjustment, rather than create a negative asset, will be taken to the profit and loss, so income statement. The third type of lease change will be where we are extending the scope of the lease. Now, this might be where we have a property and we are extending to take more floors of an office building, or it might be an equipment lease and you are hiring extra pieces of equipment on the same lease, or on the same sort of master lease agreement. Now, if you're doing that, quite often you will get a discount compared to the standalone selling price that someone would charge if they were just leasing you the additional floor space or the additional equipment. And if you are receiving that discount, then we will calculate the new lease liability using the consideration and revised lease terms, but we will use an unchanged discount rate, so the original discount rate when we first began the master lease agreement. And again, for this, we will be reflecting this in the right-of-use asset, increasing or decreasing, or increasing because we're increasing the scope. The final modification that typically takes place is to change the scope of the lease, but actually not receive a discount. So we simply get charged whatever somebody else would be charged if they were just taking out a new lease. In that case, IFRS 16 says we'll leave the original lease as it was and create a new lease to deal with these new extended floor space or extended pieces of equipment. And therefore we'll have an entirely separate calculation for it. Going on to the exemptions that Stephen mentioned earlier, there are two key exemptions from applying this whole model of IFRS 16. The first is for short-term leases, which are specifically leases of 12 months or less, with a proviso they cannot include a purchase option. So if it is a hire purchase lease of any length, it will automatically be under the IFRS 16 model to be considered. Secondly, you also have to consider if there are any extension options in the lease which you're reasonably certain to exercise at inception. So it might originally be a 12-month lease, but actually you know you're expecting to use the asset for 5 years and just exercise 5 years' worth of extension clauses. In those cases, it would not be counted as a short-term lease. Where you have got short-term leases, the consideration here is done on a class-by-class basis. So you have to consider an entire class of assets, underlying assets, and whether or not you want to use a short-term lease exemption for them or not. The second type of exemption is in relation to the low-value assets. And in this case, we don't have a specific number because the standard setters didn't want to have to rewrite IFRS 16 every year for inflation changes. They gave in the basis of conclusions an indication that they're thinking of numbers around about $5,000 US. Now that's 2016 when this version was issued, when this standard was issued. So over time, people will naturally increase that, but companies will need to set their own sort of threshold that you're going to use in your businesses. And once you have set that threshold and decided something is low value, you're then going to think about, well, are those assets that I'm looking at highly dependent or highly interrelated with other assets? The two sort of classic examples I can think of here, one might be getting a selection of laptops. I'm using them for my Salesforce, and each of those laptops are totally separate, can be swapped between, no requirement to consider any of those as interrelated to each other. So I would treat those as being a load of separate laptops and each of them low value. Equally, I could get a number of server blades to put together and form a software development platform. And because the server blades are all connected to each other, and one part being removed would have to be replaced in order for the whole thing to function, that would consider to be a highly interrelated or connected asset, and therefore that would not be a low value because I would have to consider all of the server blades together rather than individually. With the leases of low value assets, the consideration needs to be done on a lease-by-lease basis rather than a class-by-class basis. So you can be much more selective about when you want to apply IFRS 16 or when you want to leave it to the alternative treatment, which for both of these exemptions would be a straight line charge through the P&L, as similar with operating leases currently. Looking at transition and coming into the first time adoption of IFRS 16, there is a choice. The default choice would be full retrospective application, the same as IS 8 requires for any change of accounting policy. However, it was noted when IFRS 16 was being prepared that's an extremely large amount of work, and therefore they brought in a modified retrospective application. You have something similar with IFRS 15 also being brought in. You do not restate the comparatives in that situation. You only have to bring in the changes from IFRS 16 as essentially a day one adjustment in your statement of changes in equity into the current year. Along with that modified retrospective application, they also brought in some practical expedients to help people process this in a more efficient manner. Firstly, we do not have to apply the definition of a lease retrospectively. Now that means in some cases we save time, but also we actually save practicality. Looking at Stephen's example from earlier, to apply the definition of a lease at the start of that, you would need to know the size of the airport and how many spaces the kiosk could have been in. If the lease had been 20 years, going back 20 years and knowing what the history of the airport is might be rather difficult. And so applying the definition of a lease as at the date of application makes it an easier process. Also, if you're doing the modified retrospective approach, where you have leases that are near the end of their life, so they may have been a very long lease but are within 12 months of the end of at initial application, you can treat them as short term and therefore just a P&L charge rather than creating the asset and liability. Similarly, there are some slightly simplified calculations of the right of lease asset or right of use asset rather than trying to create an asset and depreciate it. And we also have an option of using a single discount rate to a portfolio of leases. Now hopefully you'll see a second poll question come up. And while you're answering that polling question, I'm just going to talk briefly about IFRS 9 and 15. We wanted to briefly cover these because the FRC have been issuing some thematic reviews on these areas, looking at interim accounts for companies that have been applying IFRS 9 and 15 essentially for their December year ends. And they looked at IFRS 9 first of all, and as a reminder, this introduces a new asset model based a bit more on the business model that you actually run rather than purely a list of rules as IAS 39 used to do. So you have a collect and sell or a trading business model as far as financial instruments go. And they looked specifically at non-banking entities, finding actually there would be no material change to those entities as a result of IFRS 9. They had some changes, but not material ones. There were some issues they noted in disclosure that some of these companies had not actually applied all of IFRS 9 and therefore they wanted to propose some improvements. Essentially, the FRC were providing early warning of reviews they were going to be doing on the full accounts. They did notice, for instance, there was some concern over whether IFRS 9 had been properly applied to the new contract assets, which we used to call accrued income. And also the embedded derivatives treatment, which used to be separated out under IAS 39, now the entire asset has to be revalued, wasn't clear that had always been done. But the expected loss model change that had been brought in so far appears to have had a relatively limited impact, especially on non-banking entities. Looking at IFRS 15, we have, again, a new model here, which is a fundamental change to how we consider revenue as far as the conceptual approach, creating new things like performance obligations, and changing from a risks and reward transfer question to a control transfer question. When does your customer take control over the good or service you're providing? That's when revenue will be recognised. And I noticed in this there were many companies which had very significant changes to revenue, although in both directions. In many cases revenue was being deferred, but in some cases revenue was being brought forward. There were also changes to the balance sheet to watch out for, with, say, the creation of these new contract assets instead of accrued income. Interestingly, for IFRS 15, there were quite a lot of people using the fully retrospective model, so restating their comparatives. 41% of the sample they looked at, compared to 59% using this modified retrospective approach. I suspect for IFRS 16, it will be even more using the modified retrospective approach. One or two of their sample actually early adopted the standard, and therefore there will be more information on those companies, I'm sure, coming through soon. New policies were fairly well disclosed in the sample they looked at. However, there were issues around the change in policy and the effect of that change not always being clear in the interim accounts they were looking at. And they're hoping that will be much clearer when the final accounts come through. If we can see the results of that poll now. Yes, okay, I'm not surprised there. Look, significant proportion using the modified retrospective approach. Very few people planning the full retrospective. And that's probably what I was expecting. We go on to the next slides. And again. I just wanted to leave this slide up, and the slide packs will be available afterwards to you. This is a list of the data that's required in order to gather the information you need to prepare the lease calculations, the lease liability and the right of use asset. As you can see, there's quite an extensive list of things, some of which will be a while ago, especially if you're using a fully retrospective approach. So be aware of that information that you need, and it might be worth having that slide when you're starting your plans and processes on this to tick off that you've got all the information available. And with that, I'll hand over to Alistair to discuss the tax implications.
Thanks, Ben, and good morning, everyone. I'm conscious we have a mix of both accounting and also some tax people on the webinar today. So I'm not planning on going into great technical detail on the tax implications of IFRS 16. Instead, the plan is really to give you all a taste of what is likely to be relevant to your organisation in the coming months and years. I'll also at the end just touch briefly on IFRS 9 and 15, which is probably more pressing in the coming months. So by way of a quick update, the Finance Bill has been published with relevant tax legislation associated with IFRS 16, but this is expected to be enacted in the new year now, given what's going on in Parliament. But we're still awaiting HMRC guidance and have not been advised when this will be issued. Hopefully this will provide further colour to the tax implications, provide some useful context and examples for us all. So before we jump into some of the tax implications on IFRS 16, I thought it may be helpful to provide a brief reminder of the current tax implications on leases. So where an asset is acquired under hire purchase, capital allowances, so tax depreciation effectively, is generally given as though there was an outright cash purchase, and so subsequent instalments of capital are therefore ignored. Whereas if we look at a finance lease, in contrast, these are often considered to be an alternative form of purchase, and tax deduction for capital allowances are generally not available. Instead, the accounting depreciation on these assets is usually allowable as a tax-deductible expense. From an interest perspective, any interest or other finance charges on an overdraft, loan, hire purchase agreement or finance lease agreement to fund the purchase of these assets is seen as a tax-deductible expense. So again, no part of this is considered as a capital cost of the asset. If alternatively a business rents capital equipment, so for example an operating lease, then as with other rents, this is a revenue tax deduction, and again, no capital allowances are claimed. For capital allowances, however, there are some special rules for leases which meet the tax definition of a long funding lease. Under these complicated rules, the lessee may be entitled to capital allowances, which is different to the normal finance operating lease we've just discussed. The interest element of the lease rental is then taxable for the lessor and deductible for the lessee. Broadly speaking, the long funding lease rules applies to plant and machinery accounted as a finance lease that is not considered a short lease. A short lease in this context is not easily defined, but broadly it's beyond 5 or 7 years, depending on a number of different circumstances. So that's a very brief summary of the current tax rules with regard to leases. But in future, this all changes. So as all leases will now be on balance sheet, the lessee will obtain tax relief for the interest on the finance liability and accounting depreciation on the non-financial asset. So in summary, more akin to the current tax treatment for a finance leased asset. Alternatively, where the long funding lease rules apply, the lessee will claim capital allowances under these rules. So on this slide, we're going to discuss the tax implications of the transitional adjustments. So on adoption of IFRS 16, and as previously mentioned from an accounting standpoint, there will likely be a transitional adjustment. This adjustment is taken through equity and so will not be immediately tax deductible, but instead will be spread over the life of the various leases for tax purposes. The bad news is that this spreading calculation is complex and will likely require a significant amount of data. Companies will be required to prepare separate calculations for each lease going forward. In addition to a current tax impact, which is likely to be a tax deduction assuming net assets reduce, there will also be deferred tax considerations. Again, if we assume the net assets are reduced, this will give rise to a potential deferred tax asset. Recognition of this will need to be considered, but assuming it's recognised, it will partially offset the overall balance sheet reduction by the tax rate at which the asset is expected to reverse. So most of this we would assume will be reversed at 17%, being the tax rate enacted to be effective from April 2020. So on this slide, we've included a simple, it was tried to be a simple example of the spreading calculation. So if we look at Lease 2, for example, which again is the most likely scenario, being a reduction in the net assets and a debit adjustment to equity, here there is a total transitional adjustment shown in step 1 of 15 million debit. Under step 2, we then need to calculate the relevant percentage for this lease compared to all of the transitional adjustments. So here we take the 15 million debit and we divide it by 20 million. So you may be asking, where am I getting the 20 million from? This is effectively a sum of the 15 and the 5. So you ignore the sign convention. You know that one is a debit and one is a credit. So 15 over 20 gives you your 75%. In step 3, we then highlight the period left for each of the leases. And then in the final step, we calculate the average of all lease periods. So if we start with Lease 2, we multiply the number of days left in this lease by the relevant percentage. This provides us with a total of 525 days. We then add this to the 450 days for Lease 1 to give us a total spreading period across all leases of 975 days. To calculate the transitional adjustment in each period, we then take the net transitional debit across the leases and spread this over the 975-day period. So in this example, you'd have a first-year deduction in the region of 3.7 million, which tax affected would be approximately 700,000. So whilst this is a fairly simple and straightforward example with some basic numbers, I think we can already see this is likely to be quite complicated and time-consuming, where a company has a number of leases to consider. So this next slide considers the interaction of IFRS 16 with the relatively recently introduced corporate interest restriction rules. So those of you on the webinar with significant net interest expenses, and in that context, I'm broadly speaking of interest in excess of 2 million, will be well aware of the corporate interest restriction rules, which became effective from the 1st of April 2017. These rules, again, are particularly complicated. Broadly speaking, what the corporate interest restriction rules seek to do is limit the amount of tax relief a company and its qualifying group of companies can get for its net interest and other financing costs based on a measure which is the lower of 30% of the UK tax EBITDA and a measure of the worldwide group's net external financing expense or interest. But I mean, there's various elections you can make. That's broadly where the rules are taking us. So prior to IFRS 16, in terms of obtaining interest figures for these calculations, this was relatively straightforward, and most of the information could be obtained from the financial statements. Specifically, finance lease costs expensed to the P&L were included, and operating lease costs were excluded in determining the net interest expense. As previously discussed, however, under IFRS 16, all leases and associated costs will effectively be grouped together on the balance sheet and the P&L. So this includes both the operating and finance lease costs. However, for the CIR, or corporate interest restriction calculations, companies will still need to strip out the costs incurred in relation to the legacy operating leases to exclude these from the CER calculations. So accordingly, whilst for accounting purposes, there'll be no need to track this information on operating leases, for these corporate interest restriction purposes, groups will need to maintain tax-only calculations which track the operating and finance lease costs separately. My understanding is that the operating leases in this context will follow the legacy accounting definitions. So I mentioned briefly before the long funding leases. We do see these. We don't see them to a great extent in practice, so it may not be relevant for a number of you on the call, so I'm going to quickly whiz through this slide. But to the extent groups do have assets which are deemed to be long funding leases, there are some simplifications which have been brought in around these rules, and also any long funded operating leases held at the time when the new rules take effect will effectively be grandfathered, so effectively will continue to be taxed on the same basis as before. There are some complicating factors or matters as well, so the long funding lease rules will now be based on the net present value of the asset as opposed to simply its market value, as is currently the case. And finally, deferred tax may be more complicated given the two different rules for long funding leases pre and post the new IFRS 16 rules. So moving on from IFRS 16, Ben provided a quick update on IFRS 9, so it's the new accounting standard concerning financial instruments. So effective from the 1st of January 2018, and where relevant, most groups will now need to consider the current and deferred tax implications of group reporting in the coming weeks or months in relation to this new standard and their 2018 results. Clearly, groups that do interim or quarterly reporting would have already considered this to a certain extent. Similar to IFRS 16, there are some special rules, some special tax rules to deal with the treatment of one-off transitional adjustments on financial instruments which fall within either the loan relationship or derivative contract rules on the transition from one basis of accounting to another. Tax advice will likely be required to determine which financial instruments fall within the loan relationship and derivative contract transitional rules. However, in most cases, the transitional debit or credit concerned is spread over 10 years, so a more straightforward calculation than the IFRS 16 one we just ran through. So the entity will effectively take 10% of the transition adjustment into account starting from the year that the adjustment occurs. From a deferred tax perspective, depending on whether the transitional adjustment is a debit or a credit on the balance sheet, it will represent a deferred tax liability or potential deferred tax asset. So by way of a simple example, assuming a transitional adjustment of £100 debit or asset on the balance sheet, would expect £10 of this amount to be taxable in the year of transition, with the balance of 90 being carried forward. A deferred tax liability would then need to be recognised on the 90, calculated at the tax rate the deferred tax liability is expected to be realised over the coming 9 years. It's important to note the difference between a deferred tax liability, which is required to be recognised here, as compared to a deferred tax asset, which is only recognised to the extent it's expected to be realised or utilised. So IFRS 15, again, Ben provided a quick update here. So thankfully, this is rather more straightforward than 16 and 9, but there's a key point just to make here around the potential cash flow impact from a tax perspective. So the tax will effectively follow the accounts here, as is normally the case. So whilst over the life of a contract the accounting profit remains the same, the timing of revenue recognition could have an impact on tax cash flows. IFRS 15 could result in either the acceleration or deceleration of revenue, and if not aligned to cash flows, then this could represent a net cash outflow on additional corporation tax payments. For quarterly instalment payers, this could have already had an impact of payments made. Finally, and given the reduction in corporation tax to 17% with effect from April 2020, the later the revenue is recognised, the lower rate of corporation tax to pay on these revenues. So I've mentioned on the previous slide some of the deferred tax implications as I've run through the previous slides. But in summary, there's likely to be more complexity and further detailed calculations required around the transitional adjustments for both IFRS 16 and 9, and also the different methods of deferred tax on capital allowances to the extent there's long funding leases. Calculation will be required to determine the potential deferred tax, and then as always, careful consideration and discussion with your auditors will be required as regards recognition of deferred tax assets. A further complexity will arise for groups who apply IFRS in their consolidated accounts but have not applied IFRS in the subsidiary accounts. Here, we will need to consider on an annual basis the difference in lease accounting and consolidation and consider the associated deferred tax implications. Now I'm going to pass you over to Stephen, who's going to summarise some of the key takeaways.
Thank you, Alistair. So just a brief summary to bring the session towards a conclusion. On data gathering, Ben has already run through some of the data that you will need to collect, and depending on the structure of your organisation, this may require communication and support from divisions outside of the finance department. Please bear in mind that if you have overseas subsidiaries, you may need to think about obtaining translated copies of key documents. You'll need to consider the disclosures that you will make in the next set of accounts issued prior to transition on the expected impact of the new standard, and in particular that these disclosures are not subsequently seen as being misleading. This means that you need to start collecting and analysing data sooner rather than later. Alistair, any points on tax?
Just a couple of bits to mention before, but on if the corporate interest restriction applies, just to remind you, you'll need to track your operating lease costs. And secondly, if you have any transitional adjustments on IFRS 16, then it's probably worthwhile starting to gather the required lease information for those calculations.
Alistair, turning to timetable matters. For quoted IFRS preparers, you will need to incorporate the new standard into your interim accounts following the transition date. For all preparers, you should consider whether you need to amend your internal control systems and processes for preparing your management information and whether your KPIs need to be recalibrated. There will also be an impact on your year-end procedures. We would recommend early engagement with your auditors to agree policy choices, exemptions and expedients to be taken. Alistair?
So a couple of things on timing. For tax payments, IFRS 16 could impact quarterly instalment payers for the period ended or for the 18 period. So if we think about December year end, the first payment affected would be July 2019, so a bit of time there. And then on tax reporting, so if you're quarterly or prepare interim accounts, then that will be relevant in the coming months. Otherwise, for the full year and the tax computation, you're then looking at 2020, so a bit of time. For IFRS 9 and 15, again, if you're preparing quarterly or interim accounts, I'm assuming you've already considered the implications here. If you haven't, then again, this would be something to think about, I guess, in the coming weeks or months. The main area of focus will be the transitional adjustment for IFRS 9. Just one final point to mention will be, it's probably worthwhile just when you forecast out the tax implications or the profit implications of these different accounting standards, to think about any impact these have on any interest deduction restrictions. So, for example, if you've got an advanced FinCap agreement with the revenue, are there any conditions within that agreement which you will now breach as a result of these new accounting standards?
A couple of other commercial points just to think about. Do run impact assessments and consider how the change in accounting of your financial performance will impact your financial ratios, covenants and reported results. And consider whether this requires any early engagement with other stakeholders such as your banks or lenders, regulators and credit reference agencies. Depending on the significance of the adjustments made, you will also want to consider any impact on distributable reserves. And on that note, I'd like to pass back to Amy.
Thanks, Stephen, and also thank you, Ben and Alistair. I'd conclude by saying that we haven't seen many companies really get into grips with these changes yet. But as you've just heard, there's a lot of information relating to leases that businesses could start to collate over the coming months. There are also some interesting choices to be made due to there being different ways to adopt the new standard. For example, taking that one-time equity hit on the adoption of IFRS 16, which gives the advantage of higher reported profits going forward, but comes at the cost of greater tax complexity. And getting to grips with the complications coming from having to keep track of more information is clearly another action point. I would encourage you to refer to our IFRS 16 briefing notes for a bit more information. You'll also receive the recording from today and the slides from the webinar within the next couple of days. We now have 10 minutes for some questions, so thank you to everyone for submitting those. Our first question is, will UK GAAP follow IFRS 16, and if so, when?
Thank you. The FRC consulted on updating UK GAAP and IFRS 102 for IFRS 16, and ourselves through the Institute of Chartered Accountants, along with many of the other big firms, resoundingly told the FRC, please wait. They fortunately listened to us, so we're not expecting IFRS 16 to be brought into IFRS 102 for probably at least the next 4 or 5 years. They will at some point get round to it, but it will take a fair while before we have to deal with it under UK GAAP, and there will be appropriate consultations that take place before then. If it does come in, I imagine there might be some simplifications when it does come in as well.
Thanks, Ben. And a question on the tax side. We've got our company leases, cars and vans for our employees. How will these changes affect our tax position?
So it's likely that these are going to be operating leases currently, so I assume you're getting a deduction for the rental charges as it stands. So that will change. So going forward, there'll be no deduction for that amount, but instead there'll be tax relief on the interest charges associated with these leases, and then a deduction for the tax depreciation that's going through the accounts.
We've had a number of questions coming through on how you get to the incremental borrowing rate. We think this is going to be an area that's going to cause quite a lot of thought and discussion. There is not going to be an easily accessible database of rates that people can pick up to use, and it will require consideration of whether you can have conversations with lenders and banks, even if you don't have any existing facilities for this type of asset, with them to try and get a sense check of what sort of rates they might offer for those assets on similar terms and conditions. And we would expect that there will be a fair degree of discussion around the rate being used with your auditors.
To be clear and follow up on that, one of the questions, can I use the WACC of the company? I would suggest not. The WACC includes cost of equity, whereas the incremental borrowing rate is a hypothetical rate, because it's the rate you would have to pay borrowing a similar liability for similar terms with similar collateral. Equity would not be a part of that calculation, so I wouldn't be expecting to use WACC. One of the other questions that came in related to, I have some leases that began pre-2016, pre-IFRS 16. Will the right of use asset be based on the remaining lease payments? And the answer there is going to be, it depends whether you use full retrospective or modified retrospective approach. The full retrospective will mean you're going back to the start and recalculating. If you use the modified retrospective, yes, you are looking at the present value of the remaining lease payments and ignoring the initial costs that would have been incurred in relation to that lease. Alan,
I have another tax question that's come in. We have been loss-making over the last few years and have found it challenging to support the deferred tax asset in our accounts. How will the transitional adjustments affect our DTA?
Okay, so I mean that's a very good question, and we could potentially see significant deferred tax implications as a result of IFRS 9 and IFRS 16. So to the extent it's a deferred tax liability, that will need to be recognised. But to the extent you've got unrecognised deferred tax assets already, you can recognise the deferred tax liability and then recognise these unrecognised deferred tax assets to the extent to bring this down to a net nil position. Clearly, if it's increasing your deferred tax assets, again, this will come down to consideration of forecasts and an agreement with your auditors as to what can be recognised in due course.
One of the questions we've got come in is would contracted maintenance costs be included within the lease payments? The way IFRS 16 approaches this is to refer you to IFRS 15 and start out there looking at what element of the lease payments that or appear to be lease payments under the contract would actually relate to services, and then using the separate standalone selling price, which is the concept that comes out of IFRS 15, to split out those maintenance costs and treat them as service costs, so they would be straight line without anything affecting the balance sheet. Whereas the actual payments for the asset, so the rest of the lease payments, those would be included in your calculation.
There's been a question around how the initial rent payment is dealt with. That would be taken to the right of use asset calculation. It wouldn't be expensed. There was a question early on around low value, and just to remind you of that definition, the guidance in the standard talks about $5,000 US dollars. So that's the figure that the standard setters had in mind around that item.
One question has come in on the large number of lease cars and the understanding of them moving on the balance sheet as correct. And then saying the lease payments go through the P&L, doesn't that mean there's a double charge? The lease payments that you're currently making and currently going through the P&L will now be being taken to reduce the lease liability rather than going through the P&L as well. So there won't be a there'll be a depreciation charge and there'll be an interest charge in the P&L. Those are replacing the current operating expense charge.
Thanks, Ben. I think that's all the questions we have time for today, but if you'd like to discuss anything further, please do get in touch with Stephen, Ben or Alistair. Thank you for listening and contributing to our webinar this morning. Details of our next few webinars are showing on your screens now. It would be lovely if you could join us for those too. Thanks again and goodbye from us for now.